Welcome to this video on the mechanics of volatility, where we will understand the market's waves. Volatility is a statistical measurement of how much and how quickly an asset's price changes over time. It measures the degree to which returns fluctuate away from their average. Low volatility means prices change gradually and stay steady, suggesting a predictable and lower risk environment. High volatility means prices swing sharply and rapidly, indicating a less predictable and uncertain environment. Risk is the chance of experiencing a permanent loss. Volatility is the speed and size of price movements, amplifying short-term risk but creating opportunities to buy low and sell high over the long term. Variance is calculated by finding the mean, measuring the deviation, squaring it, adding up the squared distances, and then dividing by the number of data points. Standard deviation is the square root of the variance. This acts as a predictive net, helping us estimate the range in which a stock is expected to trade most of the time. Historical volatility looks backward at past stock prices to measure what has happened. Implied volatility looks forward, derived from options prices, to estimate the market's expected future turbulence. Implied volatility acts as the price tag for options contracts. The greater the expected volatility, the higher the market price of options across the board, due to a greater probability of price swings. Beta measures a single stock's volatility relative to the entire market. A high beta stock is significantly more volatile, while a low beta stock is less volatile and more predictable. The VIX, or CBOE Volatility Index, measures the 30-day expected volatility of the U.S. stock market. It operates inversely to the market. A high VIX reading implies a risky and fearful market. Volatility is mean reverting. Periods of extreme high volatility are temporary. Eventually, uncertainty is eliminated, and the market naturally fluctuates back toward its long-term average. Investors can navigate volatility by ignoring the noise, buying the dip as a bargain hunter, or checking their beta to shift toward less volatile stocks, especially near retirement. Volatility measures the speed and size of price swings. Concepts like standard deviation, historical and implied volatility, beta, and the VIX are key tools. Volatility creates short-term risk, but offers inevitable opportunity for the prepared.